Hi guys, I'm Manu and welcome to another episode of Sweet Money. I am a CPA Canada US and you can find the link to my website down below in the description. Today's show is going to be a banger, so get comfortable, get some paper, get a pen, because we're about to go at it. There's a lot of fallacies out there as to what's better, employment income or dividend income when you start your own business. Today, we're going to put an end to all these rumors and false information. So what happens? You start your business, you start making a bit of money, and now you finally decide to pay yourself a little bit of cash. How are you going to do this? So do you pay yourself via dividends, or do you set yourself up on payroll and pay yourself via employment income? Is one better than the other, or is there a sweet combination which creates perfect harmony? Let's talk about the pros and cons of each, and then we'll work through a real-life example and see what you think works for you. For this video, I will only focus on federal taxes. Each province has their own tax rate, and each scenario is different. So this scenario in this video may not pertain to you, but it will give you some insight as to what are the benefits and what are the cons of dividends versus income. And then you have to speak with your accountant to figure out what works best for you. And if you don't have an accountant, please feel free to reach out. Okay, so first, let's delve into the pros and cons of dividend income. You save some money by not asking your accountant to run your payroll. As an employer, you have to pay the employer portion and employee portion. CPP contribution is $4,034.10. Because you're paying both sides, it equals to $8,068.20. Eligible dividends are subject to a 38% markup. Non-eligible dividends are subject to a 15% markup. If you would like me to make a detailed video on dividends, covering multiple scenarios and eligible versus non-eligible dividends, then just holler at me in the comment section and I'll make it happen. You can make your spouse a shareholder and then he or she can also get paid via dividends. And this provides two benefits. A, it depletes the cash reserves from your corporation, and B, it provides your spouse with income at a lower tax rate. Look, disclaimer here, the CRA is starting to crack down on this practice. Therefore, before you get into any strategy, please speak with your accountant. Paying less personal income tax leaves more money in the corporation, which allows for a reinvestment in the business for expansion. No RRSP or no CPP can leave you without a retirement plan. I've heard people say odd things like, I don't believe in CPP, investments never grow, government won't pay what you're owed when we retire. I just want to invest in businesses. Guys, look, there's a lot of voodoo stuff out there, including a lot of people on social media who just have no finance background. So before you start making these assumptions and conclusions and come to these realizations, ask yourself, where is this source coming from? If it's not coming from a reliable source, then that information is probably not valid. If you're getting your financial education from a 22-year-old on Instagram, you're probably not going to the right place. And unfortunately, what happens is when everyone starts to say the wrong thing, it starts to feel as if it's the gospel truth. And before you know it, it becomes an urban legend. Dividends extracted from your corp are not tax deductible at the corporate level, which offsets the tax savings on your personal income tax. Remember, guys, dividends are always paid from the corporation's after-tax dollars. If you have not purchased your first home and you only pay yourself via dividends, then you do not qualify for the home buyer's plan. I made a video called RRSP and TFSA has been decoded. I will attach this video at the end for you to watch and gather more information as to what I'm talking about. If you don't have a RRSP, IPP, or an RCA, then you will have to invest your excess cash in the corporation. This is tax suicide. because for every $1 of investment income, you lose $5 of your small business tax rate. All right, guys, that was just half the story. We still have to talk about the pros and cons of employment income. And like I said earlier, there's a lot of information that has to be looked at when deciding what is more beneficial, the dividend income or the employment income. So if your accountant is not providing you the guidance and service that you need to make the right decision for you, you have to start asking yourself some very hard questions. Think of an IPP as an RRSP on steroids. Think of an RCA as the Godzilla of cash extraction. IPP, individual pension plan, and RCA, retirement compensation arrangement, are complex and not for everyone. These two strategies can be a video on their own. And if you're interested in learning more about it, let me know in the comment section and I'll be more than happy to make that video for you. If you decide to weaponize these two strategies, it can be a game changer. CPP, Canadian Pension Plan, is money to which you are legally entitled because you have contributed towards this fund. This monthly payment is pegged to the inflation rate, meaning as you age, so will your CPP income. I've heard people say to me, I do not believe in the CPP. And for me, it's one of those hold your tongue moments. It's kind of like saying, I don't believe in the internet. Look, the internet was invented in 1965 and the CPP was introduced in 1965. And both of these products have held the test of time. And out of curiosity, what exactly is there not to believe in? The CPP that you pay as an employer is tax deductible at the corporate level. The CPP that you pay as an employee is subject to a tax credit. Your IPP is 100% tax deduction, which is above and beyond your $31,000 RRSP limit. You get a basic income tax credit of $2,000, which renders your first $15,000 of income as tax-free. The list goes on, but I think you catch my drift. Now, if you have an IPP or an RCA, you have a lot of money coming your way during retirement. Your pension income can convert into a RIF, a registered retirement income fund, which in essence is a lifelong annuity. A great strategy with pension income is that you can split that income with your spouse. And splitting that income with your spouse allows you to drop into a lower tax bracket, which can be a very effective tax strategy. Having to hire a third party to do your payroll is an expense. Making sure you have the right person is important because you want accurate deductions. Very important. Make sure you have proper internal controls when it comes to your payroll. A lot of fraud happens through payroll, and this is a real thing. Let's call a spade a spade. It would suck if you made CPP contributions your entire working career and passed away shortly into it. That money could have been invested or spent elsewhere. Hindsight is 2020. Those are the pros and cons for dividends and employment income. A lot of tough decisions, a lot of information to balance. So let's look at a real life example of an individual who owns a business. All right, guys. So let's get started here. Example number 1. We start with JT, eligible dividends. Like I said, the average income per year, $250,000. He'll earn this over 40 years, meaning the first couple of years he earned zero. Then his salary started to increase as the years went by. And then over the course of 40 years, the weighted average was $250K. So the gross up for, and we're using the 2025 tax rates. This is very important, right? Because I clearly don't know what's going to happen in the future. So let's go off of the latest tax rates. So the gross up is 38%. The 250 ends up becoming $345,000. That's taxable. You run this number through the tax tables. He ends up owing $89,000. There is a tax credit of 15.02%, which equals to a federal tax credit of $51,000. You subtract that from your $89,000 and you have a tax bill of $37,000, which means the net income that JT takes home is $212,000. Okay? And what I'll do here is let me freeze these panes. Great. So moving on to JAG. Jag wants to work strictly by receiving employment income. So, same salary, $250K over 40 years. He maximizes his RRSP limit for 2025, which is 33,810, which means he is taxed on 216,000 for a tax bill of $48,000. Now, he has made his CPP contributions. Therefore, he gets a credit of $605, which means the tax payable is $47,000. So his take-home pay is $202,000. Okay? So this is what he takes home if he's employment only. Now, you, being the star, want to do a hybrid of dividends and employment income. Okay? So how we're going to split up, so the way we split up the 250 is 187 is employment income, 62K is the dividends, and off we go with our calculations, the markup on the dividends, RRSP for our employment. We work down the tax table because your now taxable income becomes $239,000. The gross up minus let me make sure I am doing this right. 85 plus 154 is 239. Yes, correct. Sorry. That's 80. So you go down the tax. So your taxable income after the RRSP deduction and the dividend markup is 239. You run it through the tax table. Your taxable income is 54,914. Let's just make this consistent. I don't know why dividends are in capital letters and employment income isn't, but let's just say it was arts and crafts. It's the creativity of an accountant, all right? Now you have your dividend tax credit. You have your CPP credit. Your total credits are 12.8K and 605. Your tax is going to be $41,000. Your take-home pay is $208,000. All right? So as you can see, the difference isn't insanely huge, right? However, if we think about this for 1 second, let's take JAG out of the picture, okay? Because it's the worst one. Let's take JAG out of the picture. And besides, who wants to deal with JAG, right? Let's be honest. So JAG is gone. And now you're left with JT and yourself. Okay? Now, if you take home $208,000 as opposed to $212,000, it's a difference of $4,000. $4,000 over 40 years is $160,000. Okay, so on $8.3 million, 160 is nothing. It's literally nothing. It's peanuts. Okay, it will not make an impact to your lifestyle. But what does happen, and this is very important, the government will give you, as of today, roughly $13,000 every year that you survive from the age of 65 onwards. Okay, so that's guaranteed income right there. Plus, like I said, it's pegged with inflation. Number two, if you invest $31,000 for 40 years, you will have millions of dollars sitting in your pension fund. On top of that, you can split that income with your spouse or common law partner, assuming you have one. If you don't, it doesn't matter. The bottom line is your retirement is set. It doesn't matter whether your business goes bankrupt, whether you walk away from it, or whether you sell it or don't sell it. If you do end up selling the business, great. If you don't, that's also great, because your retirement has been taken care of. You are now not dependent on the sale of this business. Another point to keep in mind is when you take home $212,000 and you're expected to save from that $212,000, human psychology is such, it becomes difficult. All of a sudden, you start seeing expenses that are very enticing. It's like, let me buy this, let me do that, and then I'll start saving. It's kind of like going to the gym. It's kind of like going on that diet. It just doesn't seem to happen. Saving is the exact same psychological impact, the mindset, whatever you want to call it. It takes a lot of discipline. However, when you're on employment income, you can now tell your financial planner to automatically deduct that money at source, meaning this money will never ever touch your bank account. At the time of processing your payroll, your RRSP limit, roughly $3,000, $2,500 a month, will be automatically extracted and into your pension account without you ever seeing it, as if it never existed in your life. And when you don't see it, it kind of never happens for you, right? So there's that whole psychological dilemma to it. Now, another thing, if I still haven't convinced you that you should go with this, here's something that will. Okay, this is the mic drop moment. Unfortunately, my mic is really tiny. If I dropped it, it won't have the same impact. But think of it as my mic drop moment. When you start taking a salary and you make CPP contributions for your pension, your employment expense is $250,000 on your corporate tax return. Your payroll expense for CPP is $4,000. That's $254,000. The CCPC tax rate in Ontario is 12.5%, which means every year you save $31,754. If you were oohing and awing about putting $31,000 in your RRSP, I just gave that money back to you. If this is not a game changer, if this doesn't make you want to have a conversation with your accountant, I don't know what else will. And remember, it all starts with a simple conversation.